All right, so we got to talk about the bond market. We're seeing here a long end bear steepener where the long end is selling off more. You're seeing the yields on the long end. Let me just pull it up here. We look at the US bond yields sitting around 4.27%, not far away from where it topped out around 4.42 in October of last year. Now, when you look at the yields on the 2-year bond, right, also relatively high up there, sitting around 4.9, and topped out around July, around 5.1, right, percent. So, why am I talking about this? What do I want to tell you? Basically, I want to explain to you about this long end bear steepener. So you're seeing the bond market, especially since CPI and PPI, and we've seen a couple of times where the bond market's selling off. But if you notice that the short end, right, the 2-year bond, is not selling off as aggressive than the long end, right? And when you get the long end to sell off more aggressively, that causes the yields to move up more than the 2-year, although yes, the 2-year yield is higher than the long end. But when this phenomenon happens, and it continues to happen, what happens is the yield curve, which is right now inverted, starts to uninvert and steepen. So if you can imagine, the yield right here on the 2-year is sitting around 4.9 versus the 30-year around 4.2, right? You're seeing it slowly go up while the 2-year is not moving up. So you see that curve starts to flatten and then eventually steepen, right? Like that. So why this matters and why this is important, what is it even telling you about the markets? Now, before I get into that, my name is Daniel. I run an organization called Infovest. Infovest promotes, teaches you about macroeconomics. We teach you about things like the yield curve, bonds, stocks, commodities, currencies, etc., crypto. And we have it all in a course, teaches you about that and ties the macroeconomics with investing and trading. If you're interested in that, check out the website, www.infovesting.com. More details there on the website. And if you like content like this, hit the subscribe button on this YouTube channel here, somewhere there at the bottom, and the like button, and comment below if you'd like to see any other further future videos. So let's get back to it. The 30-year long end bond, why is it selling off? Why are the yields moving up? Why are we having the steepening? What is it telling us? Simply, what's happening is that the markets are pricing in, are expecting that interest rates are going to pause from here going forward, meaning the 2-year, the short end is not going to move that much. They expect the rates to stop here. However, since everyone last year was expecting a hard landing and a crash, and that didn't happen, the narrative that's being pushed out today and now this year is soft landing. So if that's the case, the bond market wants to test that narrative. Is that narrative true? The soft landing narrative true? Is that true? And how do they test it? Well, if soft landing is true, then that means that you can have higher yields. You can anticipate that, the markets or the economy is handling the higher interest rates and continue to show growth, robust growth, which is hence why the yields get pushed, or the selling gets pushed on the long end, causing those yields on the long end to move higher. Yes, it affects mortgage rates and long duration bonds and 30-year bonds and whatnot, because those yields move up. So the markets are testing, the bond market is testing this narrative of the soft landing, because hey, right now the economy is handling it. The growth is handling it, right? You're seeing still strong labor market growth, etc., etc., right? Inflation's coming down. So inflation's coming down. Growth is strong. We've done a lot of tightening already. So not much change on the rates. That means that growth can be, growth continues to be robust. Inflation might stick around. That means you sell the long end and the long end yields go up and test the markets, right? Pushing those mortgage rates higher and higher and see that, hey, test that people can handle the higher mortgage cost and so on, right? So, also, another reason for the long end to move down is because if the short term interest rates are not expected to move up, then that also means you start to price in that inflation might be sticky or might move up because not much tightening, because again the economy can handle the tightening that's happened, the rates that happen, the growth is still robust, and people are still spending and spending, right? Just look at it. The grocery stores, the businesses out there, they're increasing their prices, yet the consumers are just looking at it, shrugging their shoulders, and saying, there's nothing I could do about it. Prices are going up. It is what it is. The most that they could do is try to demand higher wages, right? So that's the most you could do. So I demand higher wages. That causes inflation to go up, and the businesses out there are testing also the consumers, saying that, hey, if we're hiking prices and you guys are not saying anything, then guess what? We're going to continue to hike prices, right? And we'll continue to keep these prices elevated, and you guys are just going to shrug it off and say, this is just inflation. The consumer expectation is that this inflation is going to be there lingering around for a long time. It's embedded in the consumer's mind, which is not what the central bank and the Federal Reserve wants. They don't want the consumers to think that, oh, inflation's high up there. It's a very tough, challenging job to try to convince them, because when you see that the businesses are hiking the prices or keeping the prices higher up, and they continue to still spend. You continue to see consumers go out, travel, spend money on airline tickets and hotels, go to Taylor Swift concerts, etc., etc. Do you know? Very funny. I don't know if the statistic is true. I read it somewhere, but maybe someone can verify. In Canada, there are the population's around 40 million, and about 30 million people were applying or trying to get tickets for the Taylor Swift concert. Crazy. 30 million out of 40, right? Again, don't quote me fully on this. I read it somewhere. I don't know if it's true or if it's factual, but hey, something like that, something simple as that, where people are going out and still spending money, right? Those Taylor Swift tickets are not cheap, they're expensive. Is just telling you that, hey, growth is still strong, people are still spending, inflation is still going to be up there, and if rates are expected to stay where they are, then guess what? The 30-year bond's going to sell off. Those yields are going to go up. So you've got a long end bear steepener, and the bond market's going to push those long end yields until maybe something breaks and they really going to test. This is the pivotal moment where the bond market's going to really test the narrative. Is this a soft landing or not? And usually, and if I were to pick a side, we're going to see that test turn out to be, false, where this is not going to be a soft landing and it's actually going to end up being a hard landing and more pain is going to come out of this. That's my 2 cents. Now, if you look at a similar scenario back in 2018, you also had a long end bear steepener happen in the bond curve in 2018, because the bond markets were testing that the Trump taxes, the tax cuts, is going to create a robust economy, and the bond market wanted to test if this was true or not, and then eventually that reversed, and eventually the yield curve inverted, went into inverted territory, and then hence we had the COVID crash later, a year or two later, and the markets completely plunge, right? So the long end bear steepener is very interesting. We'll see how long this plays out. My 2 cents is this is a pivotal moment where the narrative of the soft landing is going to be tested from the bond markets as the yields go up. I think that's going to create more pain for people, and I think eventually you're going to get the demand crunch. Eventually people are going to stop spending, and then you're going to maybe cause those prices from those retailers, from those businesses to come down, and then the inflation to come down, the job losses to go up, the wages also not to be sticky and maybe even reverse. Right now, we're not seeing that. But I think that's how it plays out later on. That's why this long end bear steepener is important, because this is the test. This is the true test. And now that this everyone thinks that there's no recession, everyone feels, even the consumers feel that they can continue to spend even though they're tight on many things. Eventually, I think that will come to a very strong halt later on. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.